Hello and good day, students. Today we will learn about life insurance, which is chapter 5 from your reference book. And there are 4 learning outcomes of this chapter. The first one is that you will be able to explain the basics of life insurance. The second learning outcome would be that you will be able to distinguish the different types of life insurance, basically based on the peril that is covered under life insurance. The third one is that you will be able to calculate the amount of life insurance to own. And the fourth one is that you will be able to list some of the general exclusions under life insurance policies. The first part of this chapter is that you will be learning on the basics of life insurance, and under this part you will learn 3 things, which is the definition of life insurance policy. The second one is what are the perils covered under a life insurance policy, and the third one is how to identify the primary breadwinner. So what is the definition of a life insurance policy? Basically, a life insurance policy is a policy whereby upon death or any other contingency dependent on human life, the insurance company will pay a lump sum amount, which is a face amount of the policy, which is guaranteed at the inception of the contract to the insured's beneficiaries. So I would like to highlight that for life insurance policies is not the same as property insurance, where the principle of indemnity applies. So we have learned in chapter 4 about the principle of indemnity, whereby the insurance company will value the losses of a property, and payment towards the insured will be according to the amount of losses. However, for life insurance policy, the payouts are not payable based on the indemnification of the amount of loss, because under life insurance policy, what would be paid out is based on the sum assured or the face amount of the policy. And this is because there is no specific indemnification amount for death happening. Is very difficult to quantify the amount of loss, financial loss, specifically when death occurs. So what is more relevant in life insurance, we will learn later in this chapter on the methods to compute the appropriate amount of life insurance to take up based on several methods. And the amount of coverage on human life will be decided upfront at the inception of the policy. So whatever amount of coverage that a person intends to take up will have to be decided at the upfront on the inception of the policy, and that amount will be paid out upon death of the insured. So it is not based on the principle of indemnification. Okay, next we will examine, what are the perils covered under life insurance. Basically, there are 3 types of perils covered under a life insurance policy. The first one is death, second one is disability, and the third one is critical illnesses. Usually, a basic life insurance policy only covers death of the insured. So generally, a basic plain policy only covers death, whereas disability and critical illness benefits are usually purchased as riders. So the word riders here is very common, is a very common terminology in life insurance. Basically, what is a rider? It is the supplementary benefits that are attached together to a basic policy. So just like, say, if you purchase a car, you can buy the standard version of a car, but you may opt to add on other accessories to it. Yeah, so a rider is like the accessories, the additional benefits that you can purchase by attaching these extra benefits to the basic death benefit of a life insurance policy. Okay, and the cost of insurance, okay, or premiums will depend on the features of the rider that is offered by the insurance company and the sum assured that is purchased for that rider. Okay, so how much premiums should the policyholder or the policy owner pay? Yeah, that is the cost of insurance. So it really depends on what is the sum assured of the life insurance policy and what are the additional riders that are attached to that policy. Okay, first we will look at the first peril, which is death. Basically, death covers premature death, and we can define premature death as an event of dying too soon with outstanding liabilities and financial commitments. And the primary breadwinner would be the spouse who has the most of the earning capability to support the household and growing children and or elderly parents. So a life insurance policy usually runs maximum up to 80 years old of the insured. Yeah, but it really depends on the life insurance company. Sometimes it may cover up to 80, some up to 90 or 99 years old. So later we will look at the different types of life insurance policy, and then you would be able to visualize this and understand this concept clearer.